Hey everyone, let's dive right into this explainer. Today, we're going to visualize leveling up your wealth, and we'll be using some really fun, simple stickman doodle analogies to break down a strategy that can absolutely supercharge your wealth building. Seriously, we're talking about saving big on taxes and finding completely legal ways to get past those frustrating limits the government places on your money. So we're going on a little buckets and doors journey today. We'll be hitting the Roth income wall, the Backdoor Roth, the Pro Rata trap, the mega Backdoor Roth, filling the buckets, and finally rules and red flags. We're going to build from the basics all the way up to some highly advanced tax-free tactics. All right, part one, the Roth income wall. Income limits explained. To really understand these workarounds, we first kind of have to wrap our heads around the magical value of Roth dollars and the frustrating brick wall the government puts right in front of them.
Listen, Roth dollars are incredibly powerful. The main draw here is that a Roth IRA offers completely tax-free growth and tax-free distributions in retirement. Plus, they aren't subject to required minimum distributions, or RMDs. That basically means the government never forces you to take the money out of the account. Add in the fact that they're super flexible, easily accessible, and totally independent from your employer, and you've got an absolute powerhouse of a wealth-building tool.
But because these accounts are so great, the government literally caps how much you can put in. Imagine our little stickman trying to cram his savings into a jar. That jar has a hard lid on it. For most single individuals in 2025, that base contribution limit is strictly capped at $7,000. And here's where we hit the wall. The government doesn't just limit how much you can contribute. They actually limit who is allowed to make direct Roth contributions based on your income. So if your modified adjusted gross income as a single filer is above $150,000, you are restricted to a partial contribution. And if you cross that $165,000 line, boom, brick wall. You cannot make direct Roth contributions at all, period.
Okay, let's move on to section 2, the Backdoor Roth, aka the secret entrance. Hitting a wall doesn't mean the game is over, right? Let's see how we can build on this with our very first workaround.
This two-step magic trick is honestly brilliantly straightforward. Just imagine dropping your money into a simple cardboard box labeled Traditional IRA. These are after-tax dollars. Then, you simply walk those dollars through a backdoor, which, in real life, is often just clicking a few buttons in your Vanguard, Fidelity, or Schwab account, and you convert them right into a Roth IRA. As long as those dollars didn't earn any gains while sitting in the Traditional IRA box, the whole process is completely tax-free. And once they step through that door, they grow tax-free forever. It's like a financial secret passageway.
But as we know, every game level has a villain, and for the Backdoor Roth, that villain is a trapdoor you absolutely must avoid. Section 3, the Pro Rata trap. Avoid the tax bill.
So here's the absolute crucial point. You cannot, and I mean absolutely cannot, have outside pre-tax IRA balances. Even if those pre-tax assets are sitting way over in a completely separate account, just having them will trigger what's known as the Pro Rata Rule. Now, we aren't going to get bogged down in the math today, but simply put, falling through this trapdoor could stick you with a massive, totally unexpected tax bill, and nobody wants that surprise.
All right. If you've navigated that first backdoor safely, it is time to face the boss level of this explainer. Section 4, the Mega Backdoor Roth, the boss level.
The Mega Backdoor Roth is what we like to call the apex predator of the investing world. This is a far more complex, highly nuanced strategy that heavily utilizes your employer-sponsored retirement plan to load you up with an absolute ton of tax-free money. It definitely takes some planning, but man, it is incredibly potent. To really grasp the Mega Backdoor Roth, you just need to keep this giant number in your head, $70,000. According to Section 415 of the tax code, this is the total absolute maximum contribution limit for employer-sponsored plans in 2025. Which brings us to Section 5, filling the buckets. Hitting the $70K limit, let's look exactly at how we can reach that massive number by filling up some different categories.
Let's break down how to actually hit that $70,000 limit. Imagine 3 distinct buckets our little stickman needs to fill. Bucket 1 is your salary deferral, how much of your pay you defer to your 401k.
For 2025, you max this out at $23,500. Bucket 2 is your employer contribution. Just for easy math, let's say your employer puts in $6,500 through a match and profit sharing. Okay, that totals $30,000. But wait, the Section 415 limit is $70,000. That means you have a giant empty $40,000 bucket remaining. The Mega Backdoor Roth strategy actually allows you to fill that massive remaining bucket with your own after-tax dollars and then convert all of it to a Roth, completely tax-free. Assuming, of course, no gains were made while it just sat there in the after-tax bucket.
Of course, an apex predator strategy requires some pretty incredible caution. Section 6. Rules and red flags. Navigate with care. Let's help you safely cross this financial minefield.
Look, you can't just do this in any standard 401k. First off, your plan absolutely must allow for after-tax contributions. Second, and this is crucial, your plan must allow for in-service distributions or in-service Roth conversions. That's the mechanism that actually makes the Roth piece possible. Also, a big warning here, never overextend yourself so much that you accidentally squeeze out your employer match. We always want that free money. Finally, if you're a small business owner, hold on a second. You should be highly cautious here. There are often way better, more tax-efficient deductive options for you to explore first, like maximizing your profit sharing or maybe setting up a cash balance plan.
As the source material bluntly states, make 100% certain you're doing it correctly because you don't want to do it wrong. These are super nuanced tax laws, guys. If you think you can take advantage of these secret doors but you aren't totally 100% sure how to execute the clicks, you should seriously consider contacting a professional to ensure your conversions are absolutely flawless.
Which brings us to our final thought for today. Once you navigate those walls, sidestep the trapdoors, and unlock these secret entrances, that tax-free growth really begins to accelerate. It builds and builds your wealth, completely shielded from the IRS. So take a hard look at your current strategy and ask yourself, are your dollars working hard enough right now to guarantee that one day they're going to do all the heavy lifting for you?
Freedom isn't given, it's built, and it starts with what you do next.